Interest rates are central to most all decisions in finance. That's because most finance decisions involve evaluating cash flows that occur at different times. So if we don't have a mechanism to make the value of a dollar of cash flow consistent across time, we'd be comparing apples and oranges. Interest rates, through the time value of money calculations, are that mechanism. The Economist, in a 2014 article, described finance as an economic time machine, helping savers transport today's surplus income into the future or giving borrowers access to future earnings now. Interest rates are what make that time machine work. We must be careful, though, when comparing interest rates, because rates are often quoted without taking into account the compounding frequency. This can lead to a lot of confusion and invalid comparisons because for a given quoted rate, the shorter the compounding frequency, the higher the amount of dollars that will accumulate. If you are borrowing at that quoted rate, that means you will owe more money. If you are investing at that quoted rate, you will receive a greater return. So pay very close attention to the terms around any interest rate that you encounter. First, interest rates are generally quoted as an annual rate, but not always. On occasion, you might see a monthly or a quarterly interest rate, weekly, even if you aren't borrowing from Vito down at the corner. If you are quoted a rate on an other than annual basis, you would need to multiply it by the number of periods in a year to get a comparable annual rate, which is called the annual percentage rate, or APR. APR always assumes simple interest, no compounding. Remember that it is just a way to quote a reference rate. Sometimes the APR is required by legislation, sometimes just by convention or historical tradition. It doesn't matter how often per year the interest rates are made or required to be paid by a borrower. APR is an annual rate. To determine how much must be paid each period, APR is divided by the payment frequency to give you the periodic interest rate. To determine the amount earned or owed, the principal balance is multiplied by that periodic interest rate. Compounding then comes into play after that periodic interest rate is applied. In the next period, if the same principal balance is used to calculate the interest payment, then we have simple interest. If instead the interest payment from the previous period is added to the principal balance, and the interest payment is calculated by applying the periodic interest rate to that higher principal balance, then interest is being compounded. That is, interest is being charged on previous interest amounts. Obviously, this is a great thing if you're investing. Not so great if you're borrowing. If interest is being compounded at some frequency other than annually, the total principal earned or paid will be larger than implied by the APR. And we must make some adjustments to determine a more reliable indication of the cost or earnings. These calculations give us the effective annual rate, or sometimes it's referred to as an annual percentage yield. Because APRs do not reflect the compounding frequency, let me say that again. Because the annual percentage rate does not reflect the compounding frequency, they are not directly comparable. A quoted rate, APR, of 6% compounded annually is not the same as a quoted rate, an APR, of 6% compounded quarterly. Therefore, we don't want to base our decisions about money or capital on APRs. We need to do the necessary calculations to make the APRs comparable and to make them reflect the reality of the cost of a borrowing or the earnings of an investment. One important finance comes into play here. In finance, we care about cash flow and about opportunity cost. If interest on a loan or payments on an investment is calculated with a simple interest APR, but I have to pay the interest or I receive a payment on some frequency, then compounding is effectively occurring. Even if the interest isn't added to the balance because I paid it in cash, the total cost, the total yield is as if it was added to the balance. That is because I presumably had to borrow the money or I forego some investment opportunity to make the payment. And that implies an opportunity cost. The convention is to assume that the opportunity cost is the same as the loan, same as the rate of the loan. Alternatively, if an investment pays me a dividend each quarter in cash, when calculating the return on that investment, we assume the dividend is reinvested in the investment. Since even if it isn't, I presumably invested the dividend in something similar. So regardless of the APR calculation, any cash flow frequency determines the compounding frequency. How do we go about calculating the interest due or earned on a simple interest instrument? Multiply the amount borrowed or invested by the APR, that annual interest rate, divided by the compounding frequency per year. Here's an example of borrowing $100,000 for 1 month at an interest rate of 6%. Remember, this calculates the interest amount. It tells us how many dollars we have to pay or expect to receive, but that is it. We don't want to use that APR to compare to the APR of another loan or investment. Let's see why. This is a simple example of simple interest being earned on an initial balance of $100. Each and every year, the investment earns 6%. So at the end of 5 years, the total interest earned is $30. No interest is earned or owed on the prior year's interest. The ultimate value realized is $30 of interest. By contrast, if interest is compounded annually, then the $100 investment earns $6 in the first year. But in subsequent years, the prior year's interest is added to the investment principal before calculating that year's interest. The final effect is to increase the ultimate amount earned to $33.82, relative to the simple interest case of just $30. So how do we adjust for that so that we can make a proper decision about the relative attractiveness of each of these alternative investments? Remember, both of these are a 5-year investment paying a 6% interest rate. How do we decide about the relative attractiveness? We'll see that in a moment. First, though, take note here that the unstated assumption is that no cash was paid out on either investment until the end of the 5 years. If that simple interest instrument paid us the cash at the end of each year, we would have had the opportunity to invest that cash in the same or a similar instrument. In that case, our total wealth would be the same under each investment, and the effective returns calculated would be the same. Generally, you will be quoted an APR, an annual interest rate. In the occurrence where you are given a periodic rate, monthly or quarterly, other than annual, be sure to convert the quoted rate first to an APR, that annual percentage rate. To take into account the compounding effect and to make APRs with different compounding frequencies equivalent, we need to calculate an effective annual rate. In this formula, APR over N is that periodic rate. And the numeral 1 here represents the principal. So that 1 plus APR over N represents the interest earned or owed being added to the principal balance. That process then is repeated N times per year, so we multiply that result by itself N times, which is equivalent to raising it to the nth power. To return the result to just the earnings again, we remove the principal balance by subtracting 1 from the total. The EAR, the effective annual rate, diverges more and more from the annual percentage rate, or APR, as N gets larger and larger. That is, the shorter the compounding frequency, the greater the effective rate of earnings given an APR. When N approaches infinity, we have what is called continuous compounding, and the calculations require the exponential or logarithmic functions, not necessary for our purposes. Once you have converted competing interest rates, competing quoted rates, to an effective annual rate, they all tell you how much the total cost of a loan will be per year, or how much your wealth will increase per year from an investment. With that information, now you can make rational comparisons in your decision making. Let's return to our bank loan example from before, where we were charged a 6% simple interest APR. If the interest compounds monthly, or alternatively, if we have to pay the interest monthly, we can calculate the effective cost of the loan using our effective annual rate, EAR, equation. 0.5% per month, compounded for 12 months, cumulates to 1.005 to the 12th power, which is 1.0617. Once we subtract 1 from that, then we again get the 0.0617 or 6.17%. Thus, the compound or the effective annual interest rate on the loan is 6.17% because it has monthly compounding, not the quoted rate of 6%, which is just a 6% simple interest annual rate. So once again, right, we see what we're doing here. We have the APR of 6% divided by 12 periods per year, and that is 0.005. We add 1 to that and raise that whole amount to the 12th power. When we then subtract out -1, right, and that represents basically taking the principal back out of the equation, we end up with an effective annual rate of 6.17%. Here's another example for you to work through. Given a monthly rate of 1%, what is the annual percentage rate, the APR? That's the first question. Secondly, what is the effective annual rate, the EAR? Take out a scrap of paper, answer those two questions, and pause the video here. Okay, hopefully you had an opportunity to work through this quick and fairly simple example. Let's answer first, what is the annual percentage rate? Right? So an APR, remember, we take that periodic rate of 1% monthly, multiply it by the number of periods in the year, in this case, which is 12 months, and we end up with an APR of 12%. So the APR on this loan or the APR on this investment would be 12%. But that's just a reference rate. It doesn't tell us how much money will actually be due, how many dollars we will actually have to pay, or how much wealth will actually be created over the course of the full 12 months. So to calculate that effective annual rate, or the EAR, we go back to our formula, and it's 1 plus the APR, and remember our APR now is 12%, divided by the number of periods, 12 periods. And yes, we're back there to the 0.01. If you really pull things together, you could just start with that of the 1.01 raised to the 12th. But this shows the more common example, a more general example. So 1 plus 0.01 to the 12th minus 1 would again be 12.68%. So if a loan broker was quoting you a loan that is a 12% APR, but with monthly compounding, if you think you're going to pay, say, $120 on a $1,000 loan over the course of the year, that would be incorrect. In reality, over the course of the year, the amount of interest that would accumulate would be $126.80 because of the monthly compounding. So always keep in mind when we're talking about interest rates to understand what the rate is that you're being quoted, or what is being talked about. Remember, annual percentage rates are used for calculations. You have to convert those to an effective annual rate to make decisions.